Is it 2003 all over again? Hi, everyone. Welcome to the Real Vision Daily Briefing. With me today is Jared Dillian, editor of the Daily Dirt Nap newsletter. Hi, Jared.
Hey, what's up?
Not too much. Listen, apologies, everyone, for getting a little bit of a late start. We're having some technical problems. I'm coming off being sick. I mean, it's been a struggle. The struggle is real, but we're going to get through this. And we're happy we're able to get on air. So thanks for being patient. And Jared, before we start, on happier news, congratulations on your book deal. You have not one,
Oh
but
yeah,
two books coming out over the next couple of years. That's amazing.
yeah. The essay collection is coming out next summer, and the personal finance book is coming out in the spring of 2024. And actually, both books are done. I actually finished the manuscript on both. So
Which is incredible. It's
now I
hard enough to get one book done, but to get two books done is a real feat. That's amazing. Well, listen, I
yeah.
read your essays religiously, so I know a lot of people are really going to love to see them all compiled in one place. So looking forward to that.
Thank you. Yeah, there's actually going to be 10 extra ones in there that I didn't publish online. Um, so some new stuff.
Good, good. A little teaser. I love it. So back to the here and now. We started with the question of whether it's 2003 all over again, because it's been coming up a lot in conversation. I know in your newsletter you've mentioned that it kind of feels that way to you. Is that still the case? And what are the similarities that you see?
Well, there are a lot of differences. The big similarity to me is in both cases, in 2000 and 2020, you had a massive tech bubble and a big bear market, which is still continuing. How old was I? In 2003, I was 29 years old, and I was at Lehman. And this was before I was on the ETF desk. I was doing index arbitrage, but I was on the trading floor. And, sitting on the trading floor during the tech bubble, you would hear orders for Microsoft and Intel and .com stocks like Vertical Net, stuff like that. And then around 2003, you heard different types of stocks. You heard U.S. Steel and Cleveland Cliffs and Phelps Dodge and Inco and stuff like that. And really what happened was, starting around the beginning of 2003 into 2002, you had a big shift into value, and that
Mm.
continued for 3 or 4 years, where value stocks massively outperformed. And it's starting to happen now. Like, I don't have the numbers off the top of my head, but just look at a chart of IVE, which is the S&P Value Index, and it's way off the lows.
Mm.
Even today, Best Buy, right? Best Buy was up 12% today.
Yeah,
This
that
is a
was a surprise, right? We're used to that being a
Yeah,
dog.
yeah. This is a stock that when it was on the lows, it was like a 6 or 8 PE with a 6% dividend yield, classic value stock, and now it's rallying. Remember Gap? Remember Gap from like 4 or 5 months ago? The stock got down to $4. People were talking about bankruptcy. It had like a 10% dividend yield. Gap is up 53% off the lows. And this is kind of quietly happening. And really, not a lot of people are paying attention to it, you know?
So does it feel like, I mean, that sort of begs a couple of questions, I guess. Does it feel like that it's a part of a larger move that's going to continue and that you're going to see a bigger rotation out of tech? Tech's going to be out of favor for a while, or is it just
Yeah,
that people are
absolutely.
seeking safety right now because of the uncertainty?
No, I think this is, look, like it's too early to say, but I really think this is the big secular shift that people have been predicting for the last 15 years. I mean, people have been waiting for value outperformance, and it hasn't happened. So, no, I think this is a turn, and I think that tech is going to be dead for a really long time. If you think about after the 2002 low, tech was really dead for like 10 or 11 years. So it took you a long time to recoup those losses. I think it was 10 years before the Qs got back up to the highs where they were before. So yeah.
So do you think this comes along with a shift away from passive investing to more active management?
Well, for sure, active managers are going to do better in a period of value outperformance. I mean, most hedge fund managers are value investors. Not all, but most. And the hedge fund universe has been underperforming for a long time. I think you're going to see a greater percentage of active managers outperform. I think we're going to go from 10 to 20% outperforming to 40 to 50% outperforming.
Mm.
So yeah, I think it's going to be a good environment for stock picking.
So in the value world, do you need an economy that's growing to see those stocks do well? Because, there's this big question of where we're headed. And I feel like with technology, you could sort of squeeze productivity. People were spending on that. So, you saw this growth kind of no matter what was happening with the economy because you could do more with less, all of that, all of the arguments that go into technology. If it's value, are they more cyclical? Are they more tied to how the economy's doing?
I don't think a strong economy is a precondition for value stocks to rally. I mean, valuations on value stocks got super, super low.
Mm.
This is what I like to call the 6-6 zone. I look for stocks that have 6 PEs and 6% dividend yields. And you're seeing that in Europe and you're seeing that in emerging markets. You're not seeing it as much in the US, but still, this is really as cheap as value has ever been. And all it takes is just a very subtle shift in the flows from growth into value. And you'll see those valuations expand a little bit. And a lot of these stocks will be up 20, 30% before you know it.
Wow, which is you're right. People have been waiting a long time. Some people thought it was never going to happen.
Yeah,
That
David
sort of
Einhorn said that. Einhorn said, like, he's a value investor. He says, I think it's dead forever. I don't remember his exact words, but it was something like that.
maybe evidently, perhaps spoken too soon. By the way, if you have a question, you know what to do. Put it in the comment section, drop it in the YouTube chat, or tweet us at Real Vision. The live chat on our site is still down. I know we keep saying it is being worked on, but it is being worked on. But we have some good questions already, and I want to ask one of them because the Fed is a big factor here, right? And Colin from YouTube asking, "Hi everyone, impressive close. We had stocks rally up more than 1%. U.S. stocks, all the major indices up 1%, more than 1% today, well over 1%. Impressive close." Colin says, "Will it be a 180 with the FOMC minutes?" We have seen, Fed officials really, if not intentionally, talk the market down, certainly have that effect. Does a lot still ride on what happens with the Fed here, Jared?
Well, if you remember what happened with the last minutes, by the way, does that come out tomorrow? Are the minutes coming out
Yes, I
tomorrow?
think they come out tomorrow.
Okay.
Yeah.
Yeah. So if you remember what happened with the last Fed meeting, you had a very dovish directive where the directive said that the Fed needed to consider the cumulative effect of tightening and the lagged effect of monetary policy. That was the statement that they put in the directive. It was very dovish. And then Powell came out and blew it apart.
Right.
So I think what you'll see in the minutes is more of a reflection of that directive rather than Powell's personal opinion when he was doing slam poetry during the press conference, right?
Don't make me laugh. It was slam poetry. I love that.
But no, I think I think it's going to be closer to what was in the directive. So I think I'm not going to be in the office tomorrow. I'm actually, after this call, I'm done for 5 days. But no, I expect it to be pretty dovish, and I expect the markets to react pretty positively.
I mean, everyone's been looking for this. I mean, I think we moved away from a pivot. Now it's a pause, I guess, right? Or at least a change in trajectory. But everyone's been, regardless of what the Fed said, it seems like they're gravitating more to any sign of dovishness than they are listening to the people who would try to, sound hawkish. And Powell's not the only one, right? Bullard came out, I think it was last week. I mean, I've been traveling, so I've been a little detached, but last week saying it could be 7%. You definitely have the hawks trying to toe that line, but it seems like the market's really paying attention to more of the dovish signs.
Yeah, I mean, that was kind of a scary headline, what Bullard said, and knocked the market down a little bit. But really what he was referring to was rules-based monetary policy, like the Taylor rule or the Mankiw rule or something like that. And he just said, look, if you look at the Taylor rule says that rates are supposed to be between 5 and 7%. We had the opportunity to make John Taylor the chairman of the Fed, right? If you remember, when Trump was picking Fed chairs, he had a choice between John Taylor, Jay Powell, and Kevin Warsh. And he picked Powell because he assumed incorrectly that Powell was the most dovish of the three. But, if we had John Taylor as Fed chair, maybe rates would be 7%. But, when I say we, I mean Trump. I mean, Trump rejected that in favor of something more dovish. So, like I said, 5 to 7% sounded scary, but he was really just referring to the Taylor rule and what that said. He wasn't saying that rates are getting to 7%. So.
Yeah, it's easy. But, he of all people, since he talks so much, should know that everything that comes out of a Fed official's mouth is going to be shortened into a headline. So,
the other thing about Bullard is, Bullard is not a hawk. If you look in his history going back to 2015, he was one of the biggest doves on the FOMC for a long time. Yeah. And really what Bullard is he's kind of a political weather vane at the Fed. He kind of does whatever's in fashion at any given time. Right now it's fashionable to be hawkish. He is ambitious. He wants to be Fed chair. I mean, there's an explanation for this.
Yeah, when that eventually comes up, everything he's ever said will be rolled out in front of him, and that's the lesson of politics in Washington, right? I think the less you say, the better your chances. William on the RV site asking, where is sentiment in this rally rolling over? Obviously William knows you always have your pulse on the sentiment, Jared. How does it feel to you in terms of where sentiment is right now?
I'd say on a scale of 1 to 10, 10 being the most bullish, I'd say it's about a 3.5 currently. I mean, if you look at, everyone looks at the it's hard to say, the AAII numbers. That's creeping up. It's getting a little bit more bullish. I will say, I think the general sentiment is pretty poor for reasons that have nothing to do with the stock market. One of them being crypto. The whole FTX thing is, really what that is a statement on. It's a statement about trust. You know what I mean? It's not just sort of trust in the crypto world specifically. It's kind of trust writ large. So when you have fraud that's of that magnitude, that affects sentiment everywhere. I also want to say that people are bearish on Twitter. Elon Musk taking over Twitter, firing everybody, creating all this chaos, that's creating a lot of bearish sentiment. So even though, the actual quantitative sentiment numbers say things are getting more bullish, when I look around out there, I mean, people are still pretty pessimistic.
Yeah, that's so interesting. And so there've been a lot of questions, and the whole FTX thing did seem confined. You didn't have some of the spillover effects outside in other assets, is within the world of sort of digital for now. But you make a really good point about trust. And some of the headlines coming out about sort of the egregious, behavior that took place, and complete lack of controls. I mean, the issue of a lack of trust is kind of everywhere, I think, right now. I mean, it's reflected everywhere, whether you're looking at politics, financial markets. You're seeing layoffs in technology that used to be a rock solid place where you were, those are the most sought after workers. I got an email from someone who was totally blindsided by a pink slip. So you're seeing that sort of safe place for those people falling out. So there is a sort of real lack of trust everywhere, it would seem.
Yeah. I think sentiment is still pretty bearish, and I think stocks are. I hate the phrase "the wall of worry." People say that all the time, but look, it's a holiday week. We're probably. I mean, my experience when I was trading Thanksgiving week, Wednesday and Friday, stocks always went up. Good seasonality into year end. I mean, maybe January 2nd, it's a different story. A lot of times you have big reversals around year end, but things look pretty positive going into the end of the year.
Yeah. There does seem to be a narrative that they're just forces at work, whether people are chasing their performance, their bonus, they're trying to catch up, whatever's driving it. Better than expected data, some resilience coming through, maybe people, the move into value. But come January, there seems to be, pretty widespread consensus that things are going to get ugly.
Yeah, don't you think that's interesting? I think that's interesting. I really do.
I know
Like,
whenever everyone thinks the same thing, you're always wondering, what could be wrong with that?
yeah. I mean, look, like, people think I'm a bull. Really, I'm just sort of doing the opposite of what everyone else is doing. But no, I think it's, look, like, out of a range of possibilities, the S&P is at about 4,000 plus right now. The all-time highs was 4,800. Look, like a 20% move is 800 points in the S&P. There is a chance that we have a 20% gain in the S&P in 2023. It's absolutely possible, and nobody's considering that possibility. It's funny because Chris Cole, who is a friend of mine, we were corresponding back in 2012, and we had this whole discussion about tail risk. But he actually wrote a piece in 2012 that didn't just talk about the left tail, the downside. He talked about the right tail, the upside. And he talked about how cheap, like, super upside calls were in the S&P. And if you did that, if you bought like 5-year calls in the S&P in 2012, I mean, that was a retirement trade, you know? So, like, I guess I'm just like, I'm not predicting a 20% rally next year, but like, it could happen. Absolutely.
Yeah. Well, everyone, whenever we're talking to any of you, you're always looking at probabilities, right? You're looking at
Yeah.
the range of probabilities and things that no one has a crystal ball, but what seems more likely, less likely based on, the information in front of us at any given time. Um, the same in the same way that I guess mirroring, or the reason maybe that people expect things to be so bad in January is that there is also this sense that the economy, surprisingly resilient now, is definitely going to roll over, and we are definitely headed for a recession. The question is just how painful. I want to run a clip. My colleague Andrea spoke recently with Andy Constant, the CEO of Damped Spring, who I think explained some of the thinking behind that and the link with inflation. Let's have a listen to what he had to say.
My view on the pressures is that inflation won't be well and truly killed until jobs, either some sort of financial breakage occurs where either a provider of leverage or a large industry is taken out, and jobs are cut after the breakage, or jobs need to come down because the consumer, though they're spending quite a lot and levering up some of their credit card debt, they are doing that because they expect to be employed. You don't lever up your credit card always because you're about to go bankrupt. Sometimes you do it because you expect to get a bonus or you expect to keep your job, and so you just want to spend ahead of that. And so the demand side, true demand destruction, is only going to happen if we see consumers being forced to retrench, and that happens when the job market turns.
And that full interview is available on our website. You're going to want to check it out. So, Jared, this is why this inflation issue has been so important. We've been talking about it a lot on Real Vision because, this idea that you're going to have a really strong recession, really painful recession in order to break the back of inflation. If not that, or some financial dislocation, that's the only way it's going to happen. So you're going to have rates higher for longer, and there's going to have to be layoffs in order for consumers to pull back. Are you worried that that's coming down the pike at us?
No. I mean, first of all, I don't think that people having jobs is inflationary. There's plenty of points in history where unemployment is 3.5%, 4%, and we don't have inflation. So I don't like this argument that people say people have to lose their jobs to get rid of inflation. As for the recession, we already had the recession, right? For all intents and purposes, it is over. Right now, it is going to be reflected in the data in 2023, but that's backward looking, right? We experienced the recession this year. So, I mean, just think back to the financial crisis, right? The housing market peaked in 2007. It bottomed in 2010. Stocks began to rally in March of 2009. Like the stock market discounts way out in the future, and the market was up 50% by the time the housing market turned around. So I think that's what you're seeing with the stock market today.
Yeah, that's the timing just seems so difficult, and you really have people dug in and on the camps on this, and I think it's really hard for people to sort of to figure it out because people feel really you get those inflationistas who really feel like that a lot more has to be done. I want to get a question in Melson Babe from YouTube. What's your time frame for the rotation of value? Do you see this reversing once the Fed and other central banks start burring again? I'm not sure what they mean by that, but you kind of think the rotation's already started, don't you, Jared?
Yeah, it has. And as for the central banks, like there's a couple things I don't know. I do think the Fed will cut. I do think the labor market will get worse. I think unemployment will go up a little bit, maybe to 4.5%, 5%. I think that'll be enough to get the Fed to cut a little bit, maybe to 3.5%, something like that. I don't think we're going to do QE. That's not in our future. In fact, I'm not even necessarily sure that we're going to stop QT. We might continue quantitative tightening and running off the balance sheet.
Yeah.
So, yeah.
I know in all this, so we're so fixated on the pause, how many more hikes. I'm surprised that not more people talk about the quantitative tightening, but they don't.
Yeah, there's some rule of thumb out there that says that the quantitative tightening that we're doing is worth like 200 basis points of rate hikes or something like that. So really, like monetary policy isn't at 4%; it's at 6% or something. I don't know, but
yeah, so it's there's not a lot of data to go on since the whole thing is still one giant experiment. So it's a little hard to figure it out. We've got a question about precious metals.
Sure.
What are your thoughts on precious metals?
Well, I like to say I have three opinions on precious metals: bullish, very bullish, or super bullish. And I'm pretty bullish right now. I've seen some interesting charts, and precious metals are basically, for whatever reason, they're an expression of risk right now, and they're moving in lockstep with the S&P, except for today. Gold was up this morning and then finished about unch, but aside from today, gold and the S&P have been moving in lockstep. And if you think about sort of the philosophical reason for that, both are dependent on central bank liquidity. Both are dependent on pausing rate hikes. So really, if you have an opinion of gold, you have to have the same opinion on stocks. So for the time being, it's the exact same thing.
So if you're bullish and bullish on or very bullish on metals, then you're bullish on stocks as well.
And
rates.
Bonds. And bonds. Yeah, rates. So bonds, stocks, and gold, really it's the same asset at this point.
Which is weird because it's not supposed to work that way, right? That's why it's been so painful. This year has been so painful because everything was moving down. Do you see the reverse happening next year where everything's moving up?
I don't know. Because
that would be just a continuation of strangeness, right? They're not supposed to all be correlated in that way.
Yeah, this is it's kind of a weird environment for sure.
Questions about the dollar as well. David, what's up with the dollar? Why does Jared think dollar gold will move in a which way? Maybe I can read today. Which way does Jared think dollar gold will move in a short to medium term time frame? Thank you for putting your time frame in there, David.
Yeah. The dollar chart in the short term is broken. Yeah. It's broken trend. Just looking at Euro USD, I think it probably goes to about 110 before you get a correction. So it's like, again, just like we were talking about, it's all the same trade. So actually, I wrote a little bit about this in my newsletter. Right. So sometimes I call this the blob. Stocks, gold, bonds, dollar. It's all the same trade. It's the blob. Right. It's the exact same trade. But what is driving it? Right. What is driving all of this is the Fed. Okay. And if you can predict the behavior of 17 people, then you can get this trade right. That's really what it comes down to. So, we spent some time earlier on this call talking about Bullard and some of the people on the Fed and, Warsh and Taylor and all this stuff. Really, this is what I spend a lot of my time doing. I spend a lot of my time analyzing 17 different personalities, because that's really what's moving markets, and speeches and comments. And so one of the reasons I'm bullish at the moment is because Susan Collins and Charles Evans and some of the other people on the Fed are saying we are at risk of over tightening. Okay, so they're not a majority, but they're a very intransigent minority. And you're going to see in the minutes, you're probably going to see in the minutes that there's a lot of discussion about over tightening and the risk to over tightening.
Yeah, this is what these minutes, the minutes are backward looking, and they definitely are out tomorrow, by the way. They're backward looking, but they're important because it does give you a little bit more nuance into the conversation that's happening around the table at the Fed. And you're right, there are people who are increasingly concerned about this. Listen, all of these people earlier in the fall, they were all meeting when we had the UK gilt market freaking out and stuff. People know, there all these leaders were in the room together not that long ago. When there are strains in the system, and it's not why they'll do it, but they've got to, between what's happening internationally, what's happening on the housing front in certain pockets of the economy where things are slowing down significantly, that their phone is ringing off the hook. They all do those regional surveys. They have to see what's going on the ground. So there must be a really robust discussion about how far they think they can push it before you start to see some unintended consequences. So it's not surprising, I suppose, at this point in the cycle that they would be having that conversation.
Yeah,
the question
absolutely.
is, how's the vote go, though?
Well, I don't know. It's going to be interesting. So I think the meeting is like December 15th or 16th or something like that. You might see some dissents. Look,
Which
like
means
the
you're
Fed
closer to closer to a change in policy than not. Once you start getting dissents.
The Fed is going to hike 50 at the next meeting. That's a done deal. It's priced in. Christopher Waller already said that's happening. But I don't know. Maybe you see some dissents on the other side. I don't know.
Yeah, this is a really uncertain, sort of difficult environment. And the one other thing we haven't talked about is energy, right? Energy prices. We see oil. I think it was back down to 80 today. It's interesting. What is the oil market pricing in? Or is it sort of gearing off of China, the China COVID lockdowns again? What do you think's going on with oil? There are people who were, who were convinced that we're in a commodity super cycle and that oil was going to start, sort of bottoming or basing and having another run higher. It doesn't seem like it's done that. I don't know. What's happening there?
There's a lot of conspiracy theories about oil out there. The biggest one is that Biden gave absolution to MBS for the Khashoggi thing, and which is going to result in higher production. The only thing I'll say about oil is that, I've been bearish for a while, but the chart is actually starting to look pretty good. And the price action yesterday, where it tested 75 and then reversed intraday, that's pretty positive price action. So I'm actually, I hate to say it, but I'm actually kind of bullish in the short term.
Well, especially if you don't think that there's going to be a steep recession, that would be supportive of energy prices.
Yeah,
no?
For sure. Yeah.
Yeah. We got a question. Where did it go? On Julius asking if QT is continuing, then where do you see bond yields going?
A lot of people have pointed out that the treasuries are kind of a one-way market at this point. You got the Fed selling, you got China selling, you got Japan selling. I think 10-year rates are going to get to somewhere between 3.25 and 3.5. But really, the bigger issue is the inversion of the yield curve, which yesterday got out to 71 basis points, which is super inverted, which is the most since 1981, I think. So I don't know. I mean, if I were a fixed income trader, I probably would have put the steepener on like 30 or 40 bips ago, and I would be eating shit right now. But like at some point, that trade is going to make a lot of sense, and to put on the steepener when it's at negative 71 bips. So maybe soon.
And you don't see that because some people look at that and say, this is why we're going to see this recession, right? This is an indication that there's a recession. Do you think that signal is intact, or are we already there? And
I don't think that's what the yield curve is telling us. I think the yield curve is telling us that the Fed has over tightened. I think that's what the yield curve is telling us, that short-term rates are too high relative to long-term rates. So, honestly, if twos were at 4% or 3.5%, the yield curve would make a lot more sense. But I think the Fed is over tightened. So,
and Jared, that's, as we kind of close out here, that's my takeaway from what you're saying. You're always, I know, looking for sort of where the majority is not, and too many people are too bearish, in your opinion, and you feel like the Fed, there's a change in policy at some point. There's not going to be this deep recession everybody sees. We've already been experiencing that in some way, and the market's looking past that. And you're pretty bullish on metals, stocks, and bonds. Is that fair?
Yeah, I mean, it's really, I think a lot of people have interpreted the Fed too literally when they talk about, basically rate hikes forever is what you would call it. I think people have bought into the scare tactics and the hawkish rhetoric. I think it's more nuanced than that. So
watch this space. Those minutes are going to be interesting. Thankfully, you will be off, Jared, so you won't have to worry about it until you come back. We thank you so much, and have a wonderful, restful holiday.